Bitcoin, Ether, and other crypto coins are still in their infancy compared to most other asset groups and haven't really been through a proper recession yet. That makes making a call on what will happen to cryptocurrencies in a recession tougher than it might be for sectors such as stocks or forex, for which there is extensive historical data. When you also factor in the unique nature of cryptos and the constantly changing environment they operate in, it becomes clear that a degree of blue sky thinking is required. Fundamental and technical analysis come into play, but so does the role of regulators, inflation, and the health of crypto trading platforms. Below are the thoughts of some experienced crypto traders. The next recession will be a new experience for them as much as it will be for someone who buys crypto today. Here are the possible ways the situation could pan out. What is a recession? Recessions are relatively infrequent, but as the time since the last one grows, their word can be expected to become more widely used. The view taken by the investment community is that it's not a question of if, but when, one will occur. An economy technically goes into a recession when its gross domestic product, GDP, contracts for 2 consecutive quarters. Other metrics such as employment levels, inflation, and industrial production help gauge how severe the slump is. While no one wants a recession to happen, they are part of the natural economic growth cycle, so preparing ways to trade crypto during a recession makes complete sense. When it comes, it will pose challenges for crypto investors but also offer opportunities as well. A historical perspective on recessions. The last major global recession occurred between 2007 and 2009, and the first of the cryptos, Bitcoin, wasn't even founded until 2009. There have been momentary slumps in economic activity since then, with the March 2020 contraction caused by COVID technically being a recession, even if it was only short-term in nature. During 2020, crypto prices rallied, which raises the question of whether crypto will perform well in a recession, but on the whole, the monitoring of crypto behavior during such a period is very much uncharted territory. Gauging how cryptos might perform in a recession is made more difficult by the extreme price volatility associated with the sector. The prospects of Bitcoin will be very different depending on whether it goes into the next recession in buoyant mood, trading at $60,000 and near the all-time highs, or at the much lower price levels it crashed to in the first half of 2022. With coins able to move from one price level to another in a short period of time, a double check of the health of the market can influence the view on where prices will be when they come out on the other side. Not all recessions are the same, so even though cryptos weren't around in 2007, cross-referencing to history books can help establish the possible length and severity of a future recession. They can be short-lived and as short as 2 quarters of a year. Alternatively, they can be long-term in nature and run for several years. The repeated cycles of recessionary activity that formed the Great Depression lasted between 1929 and 1938. The final piece of historical context that can help establish what will happen to cryptos in a recession relates to how effective government and central bank policies might be. If stagflation occurs and the recession is also a time of high inflation, then those managing the economy will have to make a choice on which problem to prioritize. Could a recession be good for crypto prices? There's only a limited amount of historical information available regarding how crypto performs during a recession, but there is some. Using that data and applying more hypothetical analysis points to several reasons why crypto could perform well during the next recession. Crypto in the recession of 2020. It's worth starting off by digging deeper into the events of 2020 when the COVID-led lockdown of global economic activity triggered a recession. It was relatively short-lived, thanks to groundbreaking stimulus measures that governments quickly introduced. But in the 12 months between March 2020 and March 2021, the price of Bitcoin rose by a staggering 994%. Part of that price surge was down to global interest rates plummeting to near zero, which reduced the appetite investors had for holding cash. At the same time, central banks pumped extra cash into the financial system, increasing the risk that fiat currency could become devalued in real terms. In contrast, cryptos are structured in a way that increases supply in line with a set formula. The argument about whether crypto is a viable alternative to fiat currency is far from being resolved, but as prices surged, crypto became big news and institutional investors started taking them seriously. A report released by Morgan Stanley Wealth Management in March 2021 illustrates how the boost to prices caused by a recession brought crypto to the attention of mainstream investors. For speculative investment opportunities to rise to the level of an investable asset class that can play a role in diversified investment portfolios requires transformational progress on both the supply and demand sides. With cryptocurrency, we think that threshold is being reached. Crypto is a safe haven asset. The incredible spike in crypto prices in 2020 can also be attributed to crypto's potential as a reserve asset, a form of digital gold. The correlation between the two assets varies over time, but both offer just what investors want during a time of uncertainty, such as that seen in March 2020. Bitcoin might not yet be a highly effective means of exchange, but like gold, it is seen by many as a way to securely store wealth. Cryptocurrencies are also global in nature and transfers are made without borders, which means the coins aren't pegged to the fortunes of one country or region. It's yet to be seen whether this analysis carries over into a recession driven by economic factors rather than a worryingly new challenge of a global pandemic. But crypto's credentials as a safe haven asset were boosted during 2020. Hardcore crypto enthusiasts. The crypto price spike in 2020 was followed by a period of price consolidation and a dramatic sell-off in 2022. This reflected speculators locking in profits and moving out of positions. Crypto prices could head to zero, but at some point, there will be resistance from hardcore fans of coins. The passion for crypto shown by these true believers is also likely to be recession-proof, which suggests there is a groundswell of long-term support that will provide a base-level price for coins. Cryptos, recessions and creative destruction. The uncertainty associated with recessions could fit in well with the innovative nature of cryptos. The tech-heavy approach and startup mentality of the sector puts it in a position to thrive on the creative destruction brought on by economic turmoil. Not all of the coins will make the right call, meaning some could collapse, but that will allow other coins to grow as they fill the vacuum. Howard Greenberg, a cryptocurrency educator at Prosper Trading Academy, tips Bitcoin to do well. Speaking with Coinbase, he said, "During an extended recession, I think we will see positive price movement with BTC, but the rest of the crypto market would face headwinds as investors continue to move risk off and investors find it harder to raise funds in the tighter lending market." According to Statista, there are 9,900 cryptos in existence, and some consolidation might not be a bad thing, especially for the stronger coins. Identifying which of the coins will be a winner in a recession is obviously key. An environment with a survival of the fittest ethos could help some cryptos gain enough market share to begin to look like the real deal. It could be a mistake to read too much into the crypto bull market of 2020 coinciding with the recession of that year. The exceptional circumstances of the pandemic and lockdown created an opportunity for millions around the world to surf the net and consider new ideas such as cryptocurrencies. Not all recessions will be similar in nature. Crypto and interest rates. One scenario that could result in lower crypto prices during a recession involves stagflation, a period of contracting output but also rising prices. The extra liquidity pumped into the global financial system since 2009 could result in central bankers facing this challenge during the next downturn. Worryingly for crypto fans, the history book suggests that in such instances, inflation tends to be the primary target. The textbook response is for interest rates to rise, instead of fall, and potential returns from cash diminish the attractiveness of cryptos as an investment. Crypto is regarded as a high-risk investment, and these types of assets are the first to suffer during a recession. Any fear factor is particularly worrying for crypto investors due to the sector still being in its infancy. Crypto infrastructure during a recession. Cryptocurrencies themselves may be virtual, but the platforms that support them are very real and will face the same challenges other businesses do during a recession. The collapse of Luna and the Terra blockchain in May 2022 serve as reminders of how badly things can go wrong, with that coin losing 99% of its value overnight. In June 2022, during a time when fears of a pending recession were building, the specialist crypto platform Coinbase announced it was laying off 18% of its staff. This move came down to business fundamentals and over-aggressive growth plans being scaled back. But such moves are alarming in an industry full of highly leveraged firms. Actions such as those of Coinbase damage investor confidence and raise the question, is my crypto safe? Investors who are looking to enter the market and buy crypto during a recession would do well to consider the structure of their broker. Firms such as those found on the shortlist of good crypto brokers offer trading in crypto markets, but some deal in other asset groups as well. With their income streams being better diversified, they offer access to crypto but haven't gone all in on the sector. The fast-moving nature of the crypto space means some questions remain unanswered regarding how cryptocurrencies perform during a recession. One of the most important outstanding wildcard items is how regulators might treat cryptos during an economic slowdown. High-profile firms go bust during a recession, in cryptos, and the exchanges that support them won't be immune to that. If that results in investors losing out, then regulators could use it to justify a clamp down on the sector. That's when things get interesting. Would greater regulation result in die-hard fans leaving the space, or would it bring the coins further into the mainstream? If it is the latter, then prices can be expected to surge, but it's hard to tell because cryptos are yet to navigate a long-term recession or one where their prices fall rather than rise. What do big investment firms do when markets sell off? Understanding the way big investors operate in the market can reduce trading risk and enhance returns. Professional investment firms which manage other people's funds have certain built-in characteristics which can lead to them following particular paths during a sell-off. With so much cash being managed by them, big investors will often dominate price movements, at least in the short term. Small investors might be right about a particular asset being undervalued, or worth holding onto. But cash is king, and if a pension or hedge fund position is large in terms of daily trading volumes, then any decision by them to sell out of it will lead to the price heading south. That fire sale approach could be adopted for various reasons. It could be stock-specific, down to broader risk aversion, or even internal changes at a fund. Drawing on the knowledge of experienced traders, we explore hedge funds during a market sell-off. Identify your starting position. Small and big investors both face the same dilemma when markets begin to sell off. The reaction of both will largely be driven by how much of their total capital is currently invested and how much is sitting on the sidelines and available to buy the dips. In terms of institutional investors, it's also possible to break them down into those who are trading with and without leverage. Hedge funds during a market sell-off. Hedge funds originated out of a desire to generate market-neutral returns, but as a group have moved into more market-directional strategies. This isn't because market-neutral strategies don't work, but is based on commercial fundamentals. Attracting new investors to alternative investments is difficult when their competitors such as cheap-to-buy ETFs cover the broad market and post double-digit returns thanks to a rising tide lifting all ships. Hedge fund managers might consider themselves the smartest guys in the room and might make money in a wide variety of market conditions, but their fees are high, and returns can be held back due to the hedging of risks that they carry out. One way to get around this problem can be to skew strategies to be directional, unhedged, and use leverage. Hedge funds and leverage. The classic market-neutral long-short strategy where two similar assets are simultaneously bought and sold is designed to generate a return even if the broader market goes up or down 10%. The short and long positions net each other off in terms of market direction, but the relative outperformance of one of the assets hopefully comes good. Two good examples would be long-short BP and Shell, or Ford versus General Motors. Strategies like long-short equities might make only a modest return in percentage terms. Ford might only outperform GM by 1%. Scaling up on position size using leverage is often used to raise the stakes and improve total cash returns. With margin rates as low as 5% available to hedge funds, they're able to take on leverage up to 120 levels. This helps boost cash returns but does open the door to the temptation to use leverage on unhedged positions. When using leverage backfires. Retail investors who use leverage CFDs to trade the markets will be able to testify how quickly a market sell-off can eat into trading profits. The same principles are at work at hedge funds which borrow to increase the size of their trades. Losses, as well as gains, are magnified, and as with retail investors that can lead to panic selling. Liquidity in ATMs. Whilst the painful experience of being highly leveraged going into a market crash is similar for retail investors and hedge funds, there is an added layer of complexity facing the hedge fund managers. Individual investors typically operate one account and have a day job, so can simply sell out and wait to fight another day. Following the guidance to only ever trade using funds which can afford to be lost helps keep the emotion out of their trading. Hedge funds, in contrast, can be complex organizations with a lot of interrelated parts, and taking book size to zero would lead to any manager looking for a new job. If the fund works on a fund of funds basis and has different managers running different strategies, then the total capital will be allocated to asset groups which have wide-ranging degrees of liquidity. During a sell-off, the priority for the fund's senior management can switch from trading performance to ensuring there is enough cash flow to keep the operation viable. Any desire to resist panic selling and drive prices down even further has to be weighed against the need for hedge funds to meet margin calls. Even profitable positions managed by successful traders might be sold in an attempt to shore up the balance sheet and meet financing demands associated with illiquid positions. Case study: gold. During the market crashes of 2008 and 2020, the phrase used to describe selling activity in some markets was that they were being used like an ATM. With margin calls needing to be met daily, the first positions to be sold were the most liquid ones. The priority for fund managers switched from picking and holding good bets, so staying in the game. This liquidity crisis is typically seen in the latter stages of a market sell-off and can be a time of dramatic price falls. It can also mark the moment of price capitulation, when selling activity peaks just before a market rebound. During the COVID-created crash of March 2020, the price of gold fell by 13.4% in the space of 11 days. This surprised many market analysts because gold has historically been associated with price rises during a crisis thanks to its role as an asset of last resort. The conclusion which was drawn was that regardless of how attractive gold might be to investors, large funds holding a portfolio of more liquid assets sold what they could, including gold positions. This enabled them to finance positions which could not be sold, but challenges the idea that markets are logical or efficient. The reversal in gold's fortunes came on Friday, 20th of March 2020, when the metal posted only its third up day, green candle, over a period of 10 trading sessions. This was followed by a price surge, and interestingly, the rebound in the gold market preceded the stock market rally, which didn't start until Monday, 23rd of March 2020. Gold isn't typically seen as a leading indicator for stock movements, but in this instance the end of ATM-style selling pressure in the precious metals market appears to have signified that the market had overshot to the downside. The bottom in the gold market was a time when sell everything ended and the time to buy back into risk on assets like stocks had arrived. Not leveraged institutional investors, pension funds. Private and government pension funds are estimated to own up to 20% of U.S. stocks. When the retirement accounts of individuals are factored in, then approximately 37% of U.S. stock ownership can be attributed to investment managers who are seeking long-term returns. Speculative traders and hedge funds might make abnormal returns, but a large percentage of the stock market is made up by investors with a slow and steady approach. Their approach to market correction can therefore determine the nature and duration of a sell-off. Diamond hands. Buy and hold investors running long-term investment strategies tend to take a different view to hedge funds when markets crash. As they aren't focusing on short-term gains, they may well take the approach of weathering the storm. Selling out of positions in a hope to buy back at lower levels is an obvious temptation, but the investment mandates of some funds stipulate the kind of trading activity they can, and can't, carry out. Stock rotation. One trend to look out for is that pension and investment funds may be required to hold positions in a particular sector, such as renewable energy. Alternatively, they might be required to allocate a certain percentage of their capital to a particular asset class such as equities. This might limit their options and make it impossible for them to bail out of positions, but they could still respond to a market meltdown by rotating from one type of equity position to another. Working on the assumption that a market correction is a sign of a change in the investment environment, pension funds might decide to adjust the weighting of their investments. If market sentiment has shifted to bearish, then a long-term program of selling growth stocks and buying defensive stocks could be triggered by a short-term correction. Daily trading volumes. Price moves in different stocks can also be influenced by how easy it is for large funds to trade out of positions. Even during calmer moments in the market, institutional investment firms which hold a position close in size to the normal total daily trading volume will need a considerable amount of time to sell out of it. During a price crash, that problem is exacerbated and causes a vicious circle of downwards price moves. When big funds are forced out of positions in illiquid stocks, the price can overshoot to the downside. Spotting which market to buy the dip in can be helped by looking at the core statistics of different stocks. Apple Incorporated, for example, has a market capitalization approximately 4 times that of Tesla Incorporated, but the daily trading volumes in TSLA is typically 2 or 3 times that of Apple. Which cryptocurrencies perform best during a bear market? Crypto has been in a bear market since the beginning of May, when the total cap of all cryptocurrencies sank to $1.785 trillion, representing a fall of just over 20% from a 4-month high of $2.273 trillion, set on April 5th. And compared to this already depressed level, the market has continued to sink further, dropping another 23% by May 12th and remaining more or less in the same position ever since. So yes, crypto is well and truly in a bear market at the moment. However, market-wide declines hide a number of nuances and exceptions, with some cryptocurrencies holding up or performing better than most. In this article, we provide a rundown of these, examining which cryptocurrencies perform best during a bear market. And while some entries in this list will be expected, some may surprise you. Bitcoin. You may have heard of the correlation between Bitcoin/cryptocurrencies in the stock market, or, in the past, gold. But arguably the most important correlation in all of crypto is that between bear markets and rising Bitcoin dominance. By dominance, we mean Bitcoin's market cap as a percentage of the cap of the entire cryptocurrency market. Way back in 2013, this was a massive 95%. which wasn't especially surprising, given that there were only a handful of other cryptocurrencies. However, this dominance dropped significantly with the advent of Ethereum and other altcoins, falling as low as 34% with the bull market of late 2017/early 2018. It then rose again with the arrival of the 2018-19-20 crypto winter, reaching 71% in early 2021, as BTC led a new bull market. Of course, it sank down to 40% as alt season followed in mid-2021 and early 2022. Now, another bear market is here, and BTC's dominance is creeping up again. From 40% in April, it has now risen to 46.4%, according to CoinMarketCap. Assuming that this bear market is only just getting started, it's safe to bet that BTC's dominance will only increase. What this means as far as investors are concerned is that Bitcoin will do a better job of holding its value than most other cryptocurrencies, and may even see gains as traders exit from more highly speculative alts. Indeed, Bitcoin's price is basically unchanged in the past month, and has lost 55% since reaching an all-time high of $69,044 in November 2021. By contrast, here are the corresponding movements for a selection of other major coins. Ethereum, down by 20% in the past month, and by 62% since its November ATH. Cardano, up by 5% in the past month, but down by 79% since September ATH. Solana, down by 35% in the past month, and by 84% since November ATH. Dogecoin, down by 23% in the past month, and by 89% since ATH in May 2021. Sure, losing 55% since November isn't great, but Bitcoin has kind of stabilized in the past few weeks, while other major coins are still shedding value. This means that, if you have to keep your money in crypto, BTC is still the safest option. And most importantly, as with the bull runs of 2017 and 2020-21, a new bull market won't happen without BTC surging first. So it really is the best option right now. Ethereum and undervalued coins. While we've only just compared it negatively to Bitcoin, it's worth recommending Ethereum as a cryptocurrency to buy during a bear market, although this article is not financial advice. That's because the downturn has resulted in it being dramatically undervalued relative to its potential. First of all, Ethereum remains the biggest blockchain platform in terms of usage, with its total value locked in, currently $69.58 billion, making up 64.65% of the total DeFi sector. As with BTC and its dominance, this has risen from 54% in April, meaning that users have returned to Ethereum as conditions have become more uncertain. Secondly, Ethereum has something very big on the horizon: its shift to a proof-of-stake consensus mechanism. It has just successfully completed a testnet merge, which paves the way for the real merge to take place at some point later in the summer. This will make Ethereum more scalable and energy efficient, and will likely increase demand for ETH by extension. A similar principle applies to other altcoins with strong fundamentals. This includes Cardano, XRP, Avalanche, Polygon, Internet Computer, Polkadot, and others, which are undergoing steady growth yet are falling dramatically, due to overriding market and macroeconomic conditions. This makes them significantly undervalued, and prepares the ground for a potentially large rise once the bear market turns into a bull market again. Binance Coin and Exchange Tokens. Maintaining a focus on relativity, Binance Coin, BNB, is another token that has fallen markedly less than other major cryptocurrencies. It's down by 3% in the past month, and by only 57% since an all-time high of $686, set back in May 2021. What supports BNB's price is the fact that, as a utility token granting Binance users discounts on trades, it remains in use even during a bear market. In other words, there remains a certain basic level of demand for it, while its attachment to the world's largest exchange also means that investors may have more faith in it than other general cryptocurrencies. Stablecoins. It may seem odd to highlight stablecoins as among the cryptocurrency that perform best during a bear market, but there's little doubt that most stablecoins have, on average, retained their value more than non-stablecoin cryptocurrencies. Stablecoins such as USD Coin, USDC, DAI, DAI, Binance USD, BUSD, Tether, USDT, and the Pax dollar, USDP, remain pegged 1-to-1 to the US dollar, meaning that they have officially lost 0% during the current bear market. Obviously, most traders would prefer investments that rise in value, rather than just staying the same, but with pretty much everything falling, stable coins are basically the best of a vulnerable bunch. That said, not all stable coins are equal, and with Terra USD collapsing completely in May, investors should do their homework before trusting any particular stablecoin with their wealth. So what are the best stablecoins? In the contemporary world, where individuals are transforming to become digital, be it a small vegetable vendor or a juice corner shop, almost everyone uses digital payment methods. Due to this, the overall process of making and receiving payments has become seamless. Digitalization and increasing online payments have contributed to the growth of cryptocurrencies in India and worldwide. A highly volatile digital or virtual currency, cryptocurrency is secured by cryptography. The currency is based on blockchain technology, a distributed ledger enforced by a separate network of computers. Because of its extensive security network, it is almost impossible to counterfeit or double spend a coin. The increasing volatility in the market is driving growth to stablecoins. Many questions would be coming into your mind. What are stablecoins? What are the best stablecoins, and what are their types? What are its pros and cons? Hold your horses. We will answer every question in this article with the list of stablecoins. Let's brief you with stablecoins introduction first. Basics of stablecoins. Before diving in to know the best stablecoins you should invest in, let's get to know what they are and their significance. As you all know, cryptocurrencies are highly volatile because of their frequent changes in prices. Due to the heavy fluctuation in their prices, some investors make their fortune overnight, but some end up losing a major share. To remove this associated volatility with cryptocurrencies, stablecoins have come into existence. Stablecoins are highly reliable, unlike cryptocurrencies. These coins have emerged in the crypto space to provide investors with fixed returns and are considered much safer than crypto assets. Stablecoins are pegged into another asset with a stable value. However, they could also be backed by an algorithm. Predominantly, these coins started gaining recognition after the 2017 mania. At that time, Bitcoin rose to more than $45,000 and fell more than 50% soon after. Since then, many investors have been looking to be backed by safer and less volatile cryptos-based stores of value. In other words, you can say that stable coins are virtual or digital assets worth the value of fiat currencies or any other assets. Ideally, the price of stablecoin equals the cost of the corresponding fiat currencies, for instance, $1. The need to use stablecoins. Unlike the stock market, the crypto market trades 7 days a week and around the clock, 24 times 7. With stablecoins, the investors could sleep peacefully without worrying about how their portfolio moved overnight. They could instantly move in or move out their funds in crypto exchanges with the help of stablecoins. The best part is that they do not even need to wait for tedious banking procedures. Furthermore, the investors could readily purchase a coin at a moment's notice without depending upon the bank's servers. In emergencies, it immensely helps investors cash out their funds, which are just a click away. While the majority of the stablecoins peg their value to the US dollar because of the current financial system, some stablecoins are pegged into commodities like gold or other fiat currencies such as Euro, IMF SDR, GBP, or other crypto assets such as wrapped coins. One of the first and safest stablecoins, Utopia USD stablecoin, is built on peer-to-peer blockchain technology and maintains a 1-to-1 parity with USD. The value of the Utopia is aided by the pledge of the DAI valuable stablecoin that is pledged to the US dollar. The internal crypto exchange supports Utopia's liquidity to convert coins into any currency. Primarily, the Utopia ecosystem maintains the price stability of the US dollar, which saves users from the risk of volatility and fear of instability in the market. Moreover, this stablecoin is best known for providing users with anonymous and helping users by saving tax, accessing secure financial transactions, and offering the lowest commission in the crypto world. The value of every stablecoin is not equal. Each one is different from one another. You must know all top stablecoins to reap stupendous results after investing in them. Tether USD, USDT. Wondering why Tether is listed as one of the best stablecoins? Undoubtedly, it is the biggest and most renowned stablecoin known by almost everyone who has a little overview of the crypto world. The total market capitalization of this coin has reached $32 billion. One of the sole reasons to rank this coin at first in the list of best stablecoins is its three-pronged strategy. By implementing this strategy, Tether has successfully established 3 more stablecoins in the crypto market. Tether is backed by gold and equivalent to cash. That's why Tether is the priority for a plethora of investors because of its security and seamless integration with crypto assets to fiat platforms. Moreover, it is pegged against the USD on a 1-to-1 ratio. At the same time, another stablecoin is introduced by Tether, which is pegged against Euro. While the third stablecoin, Yen Tether, is pegged against the yen. However, there could be one drawback of using the stablecoin and being invested in this. The coin is criticized for discrepancies and lack of transparency in its collateralized reserves. USD Coin, USDC. Backed by Coinbase, USD Coin is the world's biggest broker and largest exchange holder of Bitcoin. The stablecoin is based on the Center technology, built on the Ethereum blockchain, and fully compatible with DeFi Solutions applications. The creators of this platform cooperate with organizations responsible for building the reports on the state of monetary funds. Plus, the creator offers full control over the functioning system. All the users are allowed to register on the official website after going through the simple registration process. However, only US citizens having bank accounts in their native country can return funds. Paxos Dollar, USDP. Keeping 1-to-1 parity with the US dollar. Paxos Standard created an answer to the Tether printing controversy. This one of the top stablecoins is operating on the Ethereum blockchain technology. In addition, the coin is featured as an ideal fiat collateralization token relevant to cross-border transaction fees. It is considered a reliable crypto asset by many recognized authorities, including Wall Street regulators. Moreover, it supports improving the traditional financial industry. So, what's the most intriguing aspect of this platform? Unlike other coins, it has opened up avenues for its partnership with PayPal. It will be a significant boost to the aspirants of Pax, who are looking to invest in this market and are keen to enter the world of crypto. The coin is gaining dominance over other stablecoins as even global payment gateways present trustworthy prospects for this Pax to achieve improved adoption. DAI. Offered by MakerDAO, an independent decentralized organization, DAI is a stablecoin without any centralized issuing authority, further ensuring safeguards against censorship. Similar to various other stablecoins, DAI is also based on an Ethereum-based blockchain. The asset is collateralized by the mix of other digital assets and pegged to the US dollar. Furthermore, the MakerDAO decentralized organization's protocol is followed to issue and develop the DAI token limit. Many traders use this coin to trade, however, it is more feasible on DeFi protocol services. TrueUSD. Still not able to find the most promising stablecoin? TrueUSD is one of the best stablecoins holding the potential to serve the USD fiat currency in the domain of cryptocurrency. You might be glad to know the team behind this spectacular platform behind the foundation of the stablecoin, including Google, Stanford, Palantir, and UC Berkeley. Fully backed by the US dollar, TrueUSD is the most liquid stablecoins in the world of crypto. The best part is that it offers low transaction fees compared to the wire transfers of fiat funds and enables you to maximize interest rates on your saving balance. The coin is considered an ideal platform to use against market volatility. The stablecoin features 1-to-1 parity against the US dollar. Launched in 2018, TrueUSD stores all the funds in third-party storage, wherein developers have not given any access to the funds and are not allowed to participate in the transfer. Binance USD. Binance launched Binance USD in collaboration with Paxos in 2019. This platform is also known as Bust. Although they are pretty new to the market, they have created a market capitalization value of around US $13.051 billion. They have chosen themselves to the UD dollars, improving their stability and lessening the risk. They had left no stone unturned when they created this platform to compete well with its competitors. One of the most important things about Bust is that you can use it in almost any case that is compatible with the ERC20 Ethereum platform. BUS is regulated by the New York State Department of Financial Services, making it more reliable and secure. You can also use this platform for sending money worldwide, and their tokens are issued as ERC20. Thus, whether you trade short-term or are planning to invest for the long term, this tool is an excellent option for preserving wealth and stabilizing the value of your portfolio. Haven Protocol. It is built on Monero and includes Dust, the world's first private stablecoin. It is expected that Haven Protocol will change the world by enabling users to hold crypto in private, without the risk of volatility. Considered to be one of the most credible tokens, the team behind Haven establishment comprises many proficient leaders in the domain of fintech and blockchain. Haven is an ecosystem of digital assets that gives you the ability to store, transact and convert your money in the form you choose in complete privacy. You can choose between a range of assets including the US dollar, Chinese yuan, British pound, gold, and Bitcoin among others. It has an elastic supply to allow for network growth and flexibility for users. Gemini Dollar. This is one of the top stablecoins called Gust. You should not miss this stablecoin in 2022 as it is the first stablecoins chosen against the US dollar to get recognition from a big US regulatory body. This is an ERC20 token that is based on ETH and has been modified for providing more transparent and regulatory compliance in the new financial system based on fiat currencies. It was launched back in September 2018. And the best thing is that you can store it in any wallet compatible with ETH tokens. They are currently working on improvising trust between conventional financial functionality and the blockchain ecosystem. You will be glad to know that Gust has a centralized process for protection against any security threats. Furthermore, there are regular monthly audits done by an independent accounting firm that itself offers assurance about the balance between the sum of Gust in circulation and the value of USD in reserve. Types of stablecoins. After going through the list of stablecoins, you need to know about the types of stablecoins. You can understand them and choose them as per your requirements. 1. Commodity-backed stablecoins. These stablecoins are secured with hard assets like gold or real estate. But, the most commonly used hard asset for collateralization is gold for stablecoins, as various stablecoins use a diversified collection of expensive metals. 2. Fiat-backed stablecoins. It is essential for you to know that stablecoins are backed by fiat currencies such as the Chinese yuan, which keeps a reserve of that currency as a monetary deposit. Other fiat forms comprise precious metals like platinum or silver and commodities like corn or oil. Usually, the fiat-backed crypto is the most commonly accessible stablecoins. They are very recognized, and you can also see them in the list of stablecoins for 2021. These types of stablecoins support fiat currencies like US dollars, GBP, or Chinese yuan. These are kept as collateral. Most of the fiat-backed stablecoins are supported with dollar reserves. This reserve of currency is monitored by an independent custodian that is monitored regularly to ensure compliance. 3. Crypto-backed stablecoins. There are many people who argue how crypto can back other cryptos. But the truth is that crypto-backed stablecoins have a completely different picture compared to others. These stablecoins can be found in the entire list of stablecoins available currently. These stablecoins have the capability to maintain an over-collateralized position as well. Crypto-backed stablecoins circulate relatively less supply against the reserve compared to fiat-based currencies. For example, these stablecoins may issue only $1,000 worth of coins for every $2,500 of crypto in reserves instead of keeping a 1-to-1 ratio. 4. Unsecured stablecoins. They are decentralized, but the good part is that their rate is relatively more stable. This is achieved because of the seigniorage method. It is governed and backed by an algorithm or functionality rather than any other asset or currency. The issue of fresh coins depends directly on the demand for stablecoins. The major challenge comes in the process of atoning the stability of the exchange rate. In such cases, for seigniorage-backed stablecoins, smart coins on decentralized platforms can serve as independent supporters. Pros of stablecoins. Just like other forms of crypto, stablecoins also come with various advantages that are worth knowing. The best thing about them is that they have the power of all crypto to move irrespective of any physical borders. Stablecoins are comparatively less volatile. The transaction speed is amazing as the financial transactions on blockchains are swifter than the contemporary processes. The transactions you do here do not wait for a third party to verify the transfer. Therefore, no one pays any fee to the third party. The transactions you do here get recorded on a public ledger that anyone can monitor, not like fiat currencies. Therefore, they provide you with complete transparency of transactions. The assets here are provided with real value. You can use stablecoins for preserving value for a longer duration. The good thing is that they have less dependency on state institutions. They comprise a huge role in increasing the popularity of cryptos in general. Cons of stablecoins. Along with advantages come some limitations, too. Let us dive into some of the drawbacks of stablecoins. Unlike a few cryptos, stablecoins are also usually created by centralized organizations that own the currency. There is a well-known stablecoin called DYOR, which markets itself as decentralized, and has also faced surveillance for its centralized organization. These coins must be monitored and audited by third parties as they might generate conflicts of interest to a decentralized, questionable or spurious experience. One of the major drawbacks of stablecoins is that they do not offer high ROI to investors like unpegged cryptos which you can get through staking. If you're a crypto investor, then staking is a term you'll see referenced with increasing frequency. It's an increasingly used buzzword because the process could be the route cryptos take in becoming more widely accepted. For that reason, more and more investors are looking at coins which allow staking. Staking is how some cryptocurrencies verify their transactions, and proof of stake, POS, has two benefits over the proof of work, POW, methodology that is the main alternative. It allows crypto holders to earn rewards on their holdings, and it uses much less energy. Read on for a comprehensive explanation on crypto staking. What is crypto staking? In a proof-of-stake blockchain, staking is how new transactions are added to the blockchain. By staking, holders of coins become part of the reconciliation process and are given the status of being validated. In short, by tying up your crypto for some time, you play a more significant part in the reconciliation process and, in return, might receive rewards, usually in the form of more coins. Popular cryptos which use staking include Cardano. It has an eco-friendly approach and has always used staking, and Polkadot is a protocol which allows different blockchains to connect and interact with each other. Solana and Ripple make the most of POS technology to offer a blockchain framework which has fast processing times and low fees. How does crypto staking work? One of the most important things to remember about crypto staking is that the coins you stake are still yours. The period when you stake them is just one where you can potentially collect rewards for playing a part in supporting the accounting ecosystem. The unstaking process can take some time to process, so you might not be able to sell your coins immediately. For Solana, the unstaking process is suggested to be 48 hours. Coinbase states that the most widely staked coin on its platform is Ether, part of the Ethereum network. This #1 ranking is partly because ETH currently can't be unstaked, so staking is a one-way street. Ethereum is putting through an upgrade that will complete its conversion from POW to POS, but the timeline for that coming into place keeps slipping and is currently quoted as being sometime in 2023. What kind of rewards can staking provide? Rates vary according to market conditions in the different platforms, but Coinbase reports current yields for the major coins to range from 0.15 to 5.0% APY. Smaller and emerging coins use the prospect of higher rates of return as a means of developing market share. It is essential to check how long coins are tied up for and also to check their fundamentals. There's little long-term benefit of double-digit annual rewards of a coin that doesn't have much chance of success. Why is crypto staking needed? Crypto staking is one way of addressing the fundamental challenge of crypto blockchain systems being decentralized. Traditional databases use a closed system where a single administrator enters data which acts as a record of account. In the case of decentralized blockchain systems, each participant in the system contributes updates on transactions and mining activity. Once they have been tallied and reconciled, the system records each participant's holdings. The greater the number of participants, the more work is involved. Crypto fans see that effort as worthwhile as the openness of decentralized blockchains and the crowdsourcing nature of the operation mean that records are verified by thousands of users rather than one administrator. How does staking differ from proof of work? How systems such as the one adopted by Bitcoin reward miners who solve complex mathematical problems. The first miner to get the answer correct adds a layer of transactions to the blockchain and is rewarded, for example, by being credited with Bitcoin. In POS systems, rewards are allocated more arbitrarily. Why are there so many different types of crypto proofing? Proof of stake and proof of work are the two most common mechanisms to operate the accounting infrastructure of blockchain systems. The original crypto, Bitcoin, uses POW methodology, and POS was first introduced in 2012 when Peercoin hit the market. It's sometimes easy to forget that cryptos are a relatively new concept, leaving room for other consensus mechanisms to exist. These include proof of activity, proof of burn, and proof of capacity. Why so many? As the sector hasn't yet fully matured, each approach represents a chance for a disruptor-style altcoin to come up with the holy grail of crypto processing, a reliable, secure, fast, and efficient infrastructure. The prize for the winner could be to become the base currency of the global financial system. If that were to be the case, then the value of the victorious coin would be exponentially higher than it is today. Benefits associated with crypto staking. The benefits of proof of stake have a lot to do with the inherent inefficiencies of the rival system, proof of work. POW encourages competition between miners, and as the price of BTC has skyrocketed, more miners can afford to operate even when the win-loss ratio is small. One successful attempt at cracking the mathematical equation can generate enough income to justify significant investment in a bank of electricity sapping computer servers. POW encourages an arms race where IT equipment is constantly being upgraded, and ever more electricity is being used. This article on the amount of electricity Bitcoin uses outlines how the unregulated POW free-for-all could have a catastrophic impact on the global environment. On the other hand, proof of stake doesn't require miners to solve complex equations, making it a much more eco-friendly way of running a blockchain network. Risks associated with crypto staking. Staking can require you to lock up your coins for a minimum time, and during that period, you'll be unable to sell your holding. This might result in incremental rewards being gathered, but crypto prices are highly volatile, so a plus 20% drop in the price of a coin would be a more significant influence on the total return on your trade. Another price driver to consider is that coins such as Ether, where staking is allowed but unstaking is restricted until a tech upgrade materializes, suffer from a price overhang. That reflects the likelihood that there will be a rush for the DYOR when staked coins can finally be sold. The crypto sector is still emerging, and whilst the technology used for staking has been well thought through, there is an element of risk due to potential threats to the system's security. Many of those threats are still unknown, but one which has already been identified is the risk that a large player could have enough nodes and influence to scam the framework. It is less likely with huge established blockchains such as Ripple, but smaller coins are exposed to the risk of one large investor cornering the market. Many firms support staking, and heading here will put you in the best position to start with a legit platform. Staking offers the chance to generate a passive income, but there are outstanding questions regarding the possibilities of cryptocurrencies being successful still being answered. Any crypto which wants to become the world's base currency needs to tick two boxes. The first is to be a reliable store of value, and the second is to be an effective means of exchange. To date, Bitcoin's prominent position has been based on its proof-of-work methodology, making it the go-to coin for those looking to buy crypto on a buy-and-hold basis. Bitcoin's long transaction times remain an issue, and POW processing can take minutes to process a transaction. That's not so much of a problem if you're buying a Tesla, but is prohibitive if you're buying a coffee on the way to work. Proof of work is also bad news in terms of carbon footprints. So what are the Bitcoin predictions? Bitcoin's position as the market-leading crypto doesn't make it immune from the dramatic price swings seen across the sector. If you had bought BTC in January of 2019, by July 2022 you'd have posted a 456% return. But if you'd got on the wrong end of the trade and bought in November 2021, you'd have suffered a 68% loss in value through the first half of 2022. That volatility doesn't put everyone off. Some investors are drawn to the chance to make life-changing sums of money in this market. Buying Bitcoin is a calculated risk, but hedging against regret the next time price spikes is an easy enough process. However, making a Bitcoin price prediction is more tricky. The process involves considering the factors which drive the price of BTC and developing a clear understanding of whether you are looking to run short-term or long-term strategies. Short history of Bitcoin. To better understand the future performance of Bitcoin, it is important to look at the cryptocurrency's history and goals. On October 31, 2008, Satoshi Nakamoto published the white paper for Bitcoin. Bitcoin is considered the first digital currency and the largest one by market capitalization as of 2022, with a market cap of $385 billion. Bitcoin was the very first decentralized digital currency that did not require a third party for regulation, such as a bank or a financial intermediary. Instead, Bitcoin was developed as a peer-to-peer network, where each transaction is verified and recorded on a network node on the distributed ledger called blockchain. Forks in the blockchain. After Satoshi Nakamoto stepped down from developing the cryptocurrency, the Bitcoin community took different views on how to best help Bitcoin reach its full potential. From then on, all changes made have resulted in soft and hard forks for Bitcoin. Moments when the Bitcoin blockchain takes a new direction designed to improve functionality or add new features are called forks, and these can be soft or hard depending on the scale of the change which is made. When there is no agreement in the community as to the changes that a fork will make, a split occurs and the result is a totally new currency. Since 2011, several hard forks of Bitcoin occurred, such as Bitcoin Cash, Bitcoin Gold, and Bitcoin Private. Bitcoin's transactions are all recorded on blockchain, a decentralized, distributed public digital ledger. Blockchain records transactions so that the information cannot be changed retroactively without changing all blocks. Each block is verified and each transaction is verified across millions of computers, so that the community agrees on the transaction. This method of transacting eliminates the need for verification by a third party. The whole database on the blockchain is managed through the peer-to-peer network in a distributed timestamping server. Once the data is verified and secured, the transaction participants can feel more secure regarding potential breaches of privacy, inaccuracy, or self-interest among members of the community. When each unit of data is transferred only one time, double spending, which is typical for digital assets, is eliminated. This is one of the major reasons why blockchain and Bitcoin have been so successful thus far. Each Bitcoin has a specific Bitcoin address on the blockchain. This is done through private keys, which allow each Bitcoin to have a unique address along the chain. The issue with private keys and the address of Bitcoin is that if the key is lost, there is no way to reassign ownership, since all coins with a lost address are lost as well and cannot be retrieved. To prevent this, many users have backups so as not to lose valuable coins. Mining. Bitcoins are mined. The process involves miners racing to complete complex equations, with the winner being awarded with new coins. In return, the process of mining keeps the blockchain consistent, complete, and unalterable. The process works by repeatedly grouping newly broadcast transactions into a block, which is then broadcast to the network and verified by recipient nodes. Bitcoin mining is the holding of the record contained so far on the blockchain, while adding the new transactions and making a whole, consistent and verifiable new block on the chain. After being mined, each new block on the chain must be accepted and verified by the rest of the community. This is done through the proof of work (POW) process. The POW concept is extremely important to Bitcoin mining. Since every block must be verified and accepted, it becomes very difficult for a hacker to break the chain. All transactions and funds that are done through Bitcoin are anonymous and stored in Bitcoin addresses. While many debate whether this feature is more advantageous or harmful to society, transactions with Bitcoin are transparent and secure, as every transaction is verified and recorded on the blockchain. The central issue with Bitcoin in the past few years has been its high transaction fees, and the time taken to create a new block. In a way, Bitcoin is a victim of its own success, as the increased use of the coins has exposed capacity issues. It currently takes between 1 and 1.5 hours to process a Bitcoin transaction, which limits the use of the coin in day-to-day purchases. Store of value. Some theorize that Bitcoin is a new form of digital gold, but this argument has yet to be proven. The theory claims that, like gold, Bitcoin can be seen as a safe haven asset. However, historical price data points to the correlation between gold and crypto being relatively low. The flip side of this is that residents of some countries which have experienced rising inflation, political turmoil or civil unrest have turned to Bitcoin. Bitcoin use in Venezuela increased dramatically in 2021 as its citizens struggled to navigate hyperinflation in the economy. It's now estimated that more than 10% of Venezuelans own Bitcoin, and Panamanian-based cryptocurrency exchange CryptoBuyer and Venezuelan payments processor Megasoft have created around 20,000 point-of-sale terminals in the South American nation. The world's population and even entire countries have begun to adopt Bitcoin more widely. El Salvador in 2021 took the dramatic step of becoming the first country in the world to recognize Bitcoin as legal tender. No other countries have made the same move, but that could be largely put down to the subsequent price crash in BTC. If and when prices begin to stabilize, it will be possible to carry out a more in-depth analysis of the pros and cons of the move to an entire economy adopting Bitcoin use. Financial institutions. Banks and financial institutions have had mixed feelings when it comes to Bitcoin. Jamie Dimon, the CEO of JP Morgan, has called Bitcoin a fraud. Warren Buffett, one of the greatest investors of all times and chairman of Berkshire Hathaway, recently said that Bitcoin is not producing anything and is not backed by anything, so it has no real value. Yet, the curiosity individual investors feel when Bitcoin prices rise extends to major banks and investment houses. Goldman Sachs has been working on developing a cryptocurrency trading desk, and multi-asset online brokers also offer markets in cryptocurrencies. This allows retail clients to buy Bitcoin and stocks from the same account. As a result, those interested in buying Bitcoin no longer have to use specialist exchanges or worry about what kind of wallet to use. The increased access to the market opens the door to more people buying Bitcoin, and it is now possible to buy fund-style Bitcoin instruments such as Bitcoin ETFs and Bitcoin indices. Energy use. It is impossible to establish if the founders of Bitcoin in 2009 factored in the amount of energy the coin would use by 2022. The fact that Bitcoin is responsible for approximately 0.32% of total global energy consumption has become a major headache for the coin. The approach to the system being such a drain on resources goes against the move towards a low-energy economy in legacy systems such as Visa. New low-energy altcoins could see their market share increase as a result. The reaction to the problem has focused on using renewable energy to run the Bitcoin network, and it is estimated that 57% of the energy used for crypto mining currently comes from renewable sources. The extent to which progress on this point could be crucial to the prospects and price of Bitcoin. The price of Bitcoin, past development and future trends. Anyone considering buying Bitcoin is likely to find that the market is heading at some speed in one direction or another. The price of Bitcoin is largely driven by investor sentiment, and once momentum builds, price can overshoot to the upside or downside. Lessons from the past for the future. Will Bitcoin crash again? The value of Bitcoin more than halved in 2022, but this isn't necessarily a sign that the game is over. As an example, in 2011, the price crashed by 93% within a span of 5 months. Between November 2014 and January 2015, Bitcoin's value once more dropped by 50%. The price moves might be typical, but an up-to-date Bitcoin prediction will include new variables. One primary concern right now is that regulatory bodies may suffocate Bitcoin's growing potential. Economic powers such as the United States and China have a vested interest in staying in control of their financial systems and have been reported as developing their own virtual currencies to rival Bitcoin. The announcement made by the China government that it was making Bitcoin mining and trading illegal is widely regarded as being the catalyst for a subsequent plus 50% fall in value. Those updates from governments are by their very nature hard to predict, so the only real certainty is that price volatility will remain at high levels. Value of Bitcoin, 2023 predictions. Some conservative estimates made on industry site digitalcoinprice.com peg the value of Bitcoin at $28,915 by the end of January 2023. That piece of research predicts 2023 could be the year when price moves and Bitcoin stabilizes and makes a December 2023 price prediction of $37,692. From a technical analysis perspective, the all-time high of $67,567, which was printed on 8th of November 2021, will act as significant resistance should Bitcoin reach those levels again. Investors buying in at current levels may want to consider $67,000 as a price target at which they bank some profits. A break above $67,567 can be expected to be marked by euphoria returning to the market. CEO of Nexo and Tony Trenchett predicts Bitcoin's price could exceed $100,000 before April 2023. Other financial gurus predict Bitcoin could collapse completely. Bitcoin versus fiat currencies. Satoshi Nakamoto, by creating the special mechanism through which Bitcoin will be entering the market, has created the framework in which value increases over time. This is among the biggest criticisms of regular currencies with expanding supply and falling value. An investor can think of money as a pie. When more of a currency is issued, more slices are created, though the size of the pie remains the same. As slices are created over time, the size of the slices becomes smaller. As the government prints more money, the value of GBP or other currencies decreases. This dilemma has become more pressing during 2022. Many are forecasting the global economy is entering a period of high inflation, a slowdown in economic activity, or both. Bitcoin hasn't navigated a severe recession, and so it's hard to forecast how investors will react. Will it be seen as a safer asset than the fiat currencies central banks can print at will? Or will a recession result in investors selling their positions to cope with the cost of living crisis? So, is now the time to diversify your portfolio? Diversifying your portfolio is considered by the investment community to be one of the quick wins. With markets throwing up so many challenges, it's a no-brainer to follow the tried and tested rules relating to spreading your capital to average out returns and introduce the principles of risk management. If done correctly, it just makes trading easier and more financially rewarding. Should I diversify my portfolio? This question is being asked with increasing frequency due to the underlying mood of the markets recently undergoing a change. After multiple years of benign bull market activity, COVID-19, inflation and heightened geopolitical risk have resulted in increased price volatility and market uncertainty. The principles behind diversification are simple enough, but our team of experienced traders provide below a step-by-step guide on how to optimize your decision-making and diversify your stock portfolio designed to successfully navigate the current markets. What is portfolio diversification? Diversification is a strategy that involves combining different kinds of assets with different risk profiles. Assets can be categorized by instrument type, for example, equities or commodities, by business sector, for example, large cap and small cap equities, or by geography, for example, U.S. government bonds and emerging market corporate bonds. The timeless appeal of diversification means that it has its own adage: don't put all your eggs in one basket, but analysts have optimized the process and developed several approaches. The 60-40 portfolio. This approach found favor in the U.S. in the 1970s, and the instruments used reflect those widely available at the time. Implementing it required allocating 60% of available capital to domestic equities and 40% to government bonds. The equity element offers long-term capital returns, and the bond allocation would balance out returns when equity markets sell off as bonds pay a consistent and regular yield. 2 ETFs, exchange-traded funds, that give a visual representation of the returns in both markets are the Vanguard S&P 500 UCITS ETF and the Vanguard Total Bond Market ETF, which can both be traded at this trusted broker. Not only do the total returns of the two instruments differ, but the levels of price volatility do also. The 7.67% loss on the bond position is more than counterbalanced by the 16.46% gain in the equity ETF. With the 60-40 weighting factored in, the total return on the portfolio over 12 months is 6.80%. The geographically diversified portfolio. As an increasing number of markets have become accessible, diversification strategies began incorporating equities and bonds from non-US exchanges. Due to the relative instability of emerging markets, the volatility of both the equity and bond allocation would be increased. Instruments that still offer exposure to these markets include the iShares MSCI Emerging Markets ETF and the iShares JP Morgan Emerging Bond UCITS ETF. Diversification using factors. The introduction of computers in the 1990s allowed analysts to carry out granular level research of assets. Equity markets can be easily categorized using quantifiable characteristics, known as factors, and these groups filtered to allow instruments with particular characteristics to be bought. One example is the Russell 2000 Index. This is made up of small and medium-sized U.S. equities, which have a stronger correlation to the U.S. domestic economy rather than the global markets. What are the benefits of diversifying your portfolio? Portfolio diversification is designed to manage risk and, in the process, smooth out returns. Take, for example, the expected returns of $10,000 invested in just one stock position against a collection of $100 positions in 100 different stocks. Single stock risk. The total capital allocation is the same, but if one of the positions in the diversified portfolio goes bad, the remaining positions can be expected to counterbalance that underperformance. A list of firms that have gone bust includes household names such as Blockbuster, Polaroid, Enron, and Pan Am. Nothing is guaranteed in the markets, so portfolio diversification can mitigate the risk that technological advances or corporate mismanagement take your $10,000 down to zero. Diversification averages out returns. Asset groups and types of instruments react differently when shock events such as COVID-19, wars or interest rate hikes come into play. Compare, for example, the differing price moves of tech stocks and travel stocks following the announcements in 2020 that the global economy was going into a pandemic-related lockdown. Gold is an example of an asset that has historically seen its value be negatively correlated to equity markets, and this partly explains why some proponents of diversification have held small positions in the metal. Diversifying to capture alpha. Diversification isn't all about managing risk. Some sectors with high-risk return profiles, such as biotech penny stocks, include a handful of firms that offer exponential returns, but picking a winner is never easy. Building a portfolio with exposure to a wide number of stocks, rather than just one, might result in smaller total returns but increases the risk of there being returns of any kind. Develop a trading psychology. Successful investing involves hoping for the best, but also planning for the worst. Markets don't go up in a straight line, and pullbacks and corrections can be hair-raising moments. One of the ways to be in a position to make the best decisions when markets sell off is to go into them with a diversified portfolio. This reduces the risk of a panic decision being made and selling at the wrong time. Should you be diversifying your portfolio now? Given that diversification is a tried and tested way of enhancing returns, it's safe to say that diversification should play a role in your portfolio. The details of how your portfolio is structured will come down to personal preference and investment aims. It can also be driven by market events. Since Q1 2020, the global markets have been buffeted by COVID-19, lockdowns, issues with global supply chains, and military conflict. Inflation rates are rising, and interest rates look set to also move upwards. In short, the global economy is entering a phase that is very different from that seen between 2010 and 2020. It's hard to call how any of these fundamental changes will impact prices, or what other surprise events that are currently off the radar might come into play. Reacting to the increased levels of uncertainty makes now an ideal time to diversify your portfolio. How to diversify your portfolio? The steps taken to diversify your portfolio are as simple as buying new positions, but there are some tips to help you start off in the right way. Trade in small size. If you're new to trading, one recommendation is to start trading in small size. Not only does that reduce the risk of a whipsawing price move causing you to sell out in a panic, but it also ensures that free capital is on hand to buy other positions that diversify your portfolio. The alternative approach of having to sell out of positions to free up cash generates frictional costs. These can take the form of commissions or the price difference between buying and selling prices in markets, the bid-offer spread. Protecting your trading bottom line requires avoiding costs wherever possible. Select the right type of instrument. Some research is required into the instruments you require to build a collection of assets that perform in different ways during a variety of market conditions. Equities. Historical returns suggest that your aim might be to devote a large part of your portfolio to equities, but the subcategories of the stock market throw up some interesting propositions. High-yield dividend stocks, particularly those in defensive sectors, can hold their value when the rest of the equity market sells off. Not only is their business model one that suggests that they will be able to cope with a temporary downturn, but also some big fund managers have to keep a certain percentage of their capital in the market. This can result in them rotating out of growth stocks and into the relative security of UK blue-chip stocks. Bonds. Bond markets are known for regular and moderate fixed returns. The yield on a bond is denoted at the time of issuance, so as long as the bond issuer doesn't default, coupons will be paid to bondholders in line with the stipulated terms. Bonds still reflect certain underlying economic factors. As the risk of the U.S. government defaulting on U.S. Treasuries is smaller than that of a corporate junk bond, the UST bill will pay a lower yield. To put it another way, a large tech stock may be less of a credit risk than an emerging market bond. ETFs. ETFs are a way of buying a ready-made, highly diversified product with the click of a button. The fund manager will manage the process of allocating capital across multiple firms so that you don't have to. The core risk return of the different instruments will remain the same, but the process of spreading risk is made a lot easier when using ETFs. Commodities. The commodity markets are typically regarded as being relatively high up on the risk-return scale, but finding a place for them is still recommended. The first reason is that we could be entering into a commodity supercycle, which is a period of time when substantial returns are made. The second is that they behave differently from equities and bonds when price drives such as inflation come into play. Commodities are an example of an instrument where it might be difficult to decide if the price will go up or down, but there is some degree of confidence that it will be uncorrelated to price moves in other asset classes. Forex. The US dollar is regarded as a safe haven asset, and recent market crashes have seen demand for the greenback increase. Not only does a dash for cash ensure that investors improve the overall liquidity of their asset holding, but also the US economy and its currency are regarded as the most secure in the world. Cryptocurrencies. If you've previously considered investing in crypto but held off, then the idea of a small position in Bitcoin or Ether might be what tips you over the edge. As with commodities, the position in this asset group is as much about building a portfolio where different positions react differently from the same events. Select the right broker. Rule number 1 of successful risk management is to ensure that you trade with a legit broker. If you fall for a scam, then the hard work carried out diversifying your portfolio will count for nothing. This list of trusted brokers includes established firms that have been reviewed by ASK traders to ensure that they are legit. Once you're happy with your short list of regulated brokers, filtering down to one might be helped by establishing if they offer the markets you want to buy into. This process is fast-tracked by setting up a demo account and test-driving platforms using virtual currency. Not only is this kind of trading free and zero risk, but it also helps you practice building a diversified portfolio and seeing how it performs in live market conditions. What you need to know about diversification of portfolios. You might struggle to find any experienced investors who argue against diversification of a portfolio being a good idea in principle. The devil is in the detail, and running the below checks can help you get off to the best start. Check what you are buying. It's important to check the historical performance of different assets to establish if they can be expected to perform the balancing act you require of them. The price of copper mining stocks, for example, is influenced by both the general market mood regarding equities and the price of copper. So, if you're buying equities to set off the risk associated with a copper position, then stocks from other sectors would be a preferable target. Remember the core principles. It's also important to keep in mind that successful trading is ultimately about buying low and selling high and focusing on strategies that involve investing in undervalued stocks. Holding off on entering a position might mean that you run additional risk for a short period of time, but if you're expecting a price dip in that market, then that might be a risk worth taking. Returns might be lower. There is, of course, a trade-off in terms of risk return should your favorite position zoom up in price as expected. That potential for FOMO can be managed by setting out and following a clear strategy and accepting that more moderate and consistent returns are your aim. Buy the dips. Trading returns can also be helped by adjusting your portfolio in line with market developments. A change in market sentiment could act as a catalyst for adjusting the structure of your portfolio. Also, remember that cash can be considered as part of your portfolio. Strategies designed to trade high beta stocks adopt an approach where some capital is purposefully held back so that new positions can be taken when market prices fall. Overtrading. Moving in and out of positions incurs frictional costs, and holding certain assets can incur financing costs. Your aim should be to achieve some degree of diversification, not perfect diversification.